Alex just got his year-end bonus. Before a single dollar goes anywhere, he opens 3 articles. Sell in May, January is the best month, avoid September. The calendar suddenly looks like a cheat code. 12 months, 12 chances to outsmart everyone else. So let's walk through every famous seasonal claim one by one and see what actually happens when you try to run them inside a real brokerage account. Sell in May pattern. It's May 1st. Alex reads that stocks have historically been weaker between May and October and stronger from November through April. On paper, the split looks almost too clean. 2 colored halves of the calendar, one green, one red. He hits sell on his broad market fund, parks everything in cash, and plans to buy back in November. But that split is a historical average, not a forecast. Plenty of summers ripped higher. Plenty of Novembers opened with a nasty drop. And now Alex owns a brand new problem he didn't have before. He has to decide when to come back. If November shows up with prices already higher, he pays more for the exact same shares he just sold. If he waits for a dip that never comes, his cash just sits there. The rule fits on a bumper sticker. In practice, it turns one decision into 2, and the second decision is where the trouble hides. So the calendar sold him one idea and quietly handed him a second one. January effect. Next claim on the list. Stocks, especially smaller ones, tend to bounce in January. Alex is already tempted to load up on last year's worst performers. But the story underneath the pattern isn't the calendar flipping to a new page. Near year end, a lot of investors sell their losing positions to lock in tax losses, and that pressure pushes those stocks even lower through December. When the selling fades in early January, some of them rebound. Chasing this, Alex ends up with a basket of small, illiquid, beaten-down companies. If the bounce comes, it comes with wide spreads and jumpy prices. If it doesn't, he's stuck holding the exact reason those companies got dumped in the first place. A calendar bounce built on tax flows behaves very differently from owning a healthy business, and those two get confused fast. Santa Claus rally. Now the year-end headlines show up. Analysts point to a tendency for markets to drift up across the last few trading days of December and the first 2 of January. Alex feels the pull to squeeze in a quick trade before the holidays. But look at the window. It's tiny, roughly 7 sessions. One earnings shock, one geopolitical headline, and the pattern disappears into normal noise. On a chart, 5 green days look decisive. Inside a 10-year portfolio, 5 days are almost invisible. Alex is about to bet his long-term account on a short-term coincidence in a thin holiday market where every spread costs a little more than usual. The gift, if it arrives, is small. The cost of chasing it every single year is not. The September reputation. If some months look good, others get a bad reputation, and September is the classic villain. Alex sees the ranking table, sees the red bar, and decides to pause his monthly contribution until October, just in case. But look inside that average. A handful of historical crashes drag the whole month down. Most Septembers were unremarkable. A few were brutal, and the memory of those few colors the entire chart. That's a distribution shaped by outliers, not a forecast of next September. Meanwhile, Alex skipping 1 month every year for decades adds up to years of missed compounding. He treated a scary label like a warning sign. Underneath, it was a scattered cloud of outcomes, not a prediction. And this is where the whole story starts to turn, because a fair question is forming. If all these calendar rules are so easy to spot, why are they still supposed to work? Anomaly decay. Here's the answer. If a seasonal pattern were reliable free money, professional traders would have used it into oblivion years ago. The moment a rule gets famous, sophisticated players start front-running it. If November is supposed to be strong, they buy in late October. Once that becomes obvious, someone buys in September. The edge keeps getting pulled forward and thinned out until what's left barely covers the cost of trading it. Alex isn't the first person to read this article. He's the 10 millionth. By the time a rule fits neatly on an infographic, it has usually been priced into the market it was supposed to beat. Public secrets stop being secrets, and the market quietly absorbs them. Alright, so the pattern itself is already thinner than it looks. Now watch what happens when Alex tries to trade it. The implementation leak. Switch from the chart to Alex's real broker screen. Every trip out of the market and back in triggers a cost, the spread between buy and sell prices, a commission on some platforms, and, in a regular taxable account, a tax bill on realized gains. A seasonal strategy might mean 4 or 6 switches a year. Stack those frictions on top of an already thin historical edge, and the leak is real. The bar chart of seasonal returns that looked so promising in a research paper shrinks a little every time reality takes its cut. In a spreadsheet, the pattern wins. In a real account, the same pattern often loses to just holding the fund and doing nothing. That gap between the backtest and the actual bank balance is where most calendar strategies quietly die. Cash drag. And here's the part almost nobody warns you about. Even without any trades, waiting has a price. Alex holds his bonus in cash from May to October, planning a perfect autumn entry. During those months, the fund he would have owned pays dividends he doesn't receive. Some of the strongest single days of the year land inside the window he skipped, and they tend to arrive with no warning at all. Missing even a handful of those days does more damage to a long-term return than most people expect, because compounding on what's left never quite catches back up. His cash is also quietly losing ground to inflation while it waits for a signal. The trade he never placed still cost him. Sitting out feels passive, but every day the market opens without him, that empty seat is still charging rent. Regular investing versus waiting. Back to the question Alex started with. Which month should he actually invest? The honest answer is that the month matters a lot less than whether the money is invested at all. 2 clean options sit in front of him. He can put the bonus in as a lump sum because markets have historically risen more often than they've fallen, and delay mostly costs time. Or he can set up an automatic transfer that buys the same amount every month, ignoring May, ignoring September, ignoring January, and ignoring every seasonal headline the year throws at him. Dollar cost averaging doesn't promise higher returns. It just quietly removes the one decision that keeps most beginners frozen. Alex opens the broker app, toggles on a monthly buy, and closes the tab. The calendar keeps turning pages behind him. It just doesn't get to ask his permission anymore.